Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews. And this is our monthly one on the gold market, where we bring in Mike O'Kane here, who's the head of Bullion at NZ Mint, and talk about what's happened in the gold market in the last month or so and look ahead for a commodity which has become at the centre of attention in global financial markets. And in the last month, Mike, the gold price has moved around and it's particularly increased in the last couple of weeks. What's going on with the price there?
Well, we started the year with gold price languishing around the 1360, 1350 mark US, down from its high of about 1420 in December last year. The expectation was we'd probably see that point for quite a while yet. They were talking March sort of thing before we saw any movement. In the interim, we had Egypt, Tunisia, now Libya intervene. And being major oil providing nations, oil and gold being fairly intricately tied together over the last 100 plus years.
Why is that? Because they're different things.
It's an inflation thing. There's probably the best way I've ever heard it described is gold reacts to the expectation of inflation. So as oil prices rise, there is inflation. So gold will go up because the expectation of inflation due to the higher oil prices. So what we saw was with the outbreak of protesting in Egypt, it's hard to say violence because there wasn't much, gold jumped $20 overnight and has been sitting around that 1360 area. With the Libya issue, and that is definitely a violent issue, we've seen gold pick up and essentially it broke through to 1410. And we're sitting at around the $1,400 US mark as we speak.
But it hasn't quite gone through those previous highs yet.
No, at the moment we're seeing some more short-term pressures rather than long-term drivers. So it'll be a bit more volatile probably for the next few weeks while we get another baseline established. Expectation again is still for long-term growth, but at the moment we'll probably see it up and down by $10, $20 for a few weeks yet.
Has there been much focus in the gold market on what's happening with the US government and its budget position? Because one of the underlying themes of financial markets in the last few years has been worries that the US government may not be able to keep servicing its deficit, and the US authorities may try to inflate their way out of all that debt. And therefore gold becomes a player there for those people worried about inflation.
There's a couple of points off of that. One is, again, it's that expectation of inflation does help drive the gold price. So again, all of those worries are pushing the price higher and higher. You've also got the IMF, who's now fairly key to all of these moves. So the IMF are more and more talking about issuing SDRs, special drawing rights, which essentially replaces the US currency as the central reserve currency and makes it a basket of currencies that the IMF has the right to issue. Now, part of an SDR has been hinted, and I think we spoke about it last time, where the World Bank governor suggested maybe putting gold into the SDR basket, and also you could look at valuing gold or pricing gold in SDR rights. So there's a few things going on there that essentially watch this space. It's going to be interesting to see what comes of that. Off the back of that, also China's going through a few issues. So recently the PBOC, the People's Bank of China, have announced that the reserve assets that the banks must hold has to be increased, and their biggest concern at the moment again is inflation. So we've seen a small surge in gold price before Libya. Where after an announcement from the PBOC, there was a small surge in the gold price. So definitely inflation and government debt levels is still playing a key part in the longer term aspect of gold pricing.
And China is a major player in the report that came out in the last month from the World Gold Council, their annual report on supply and demand in the gold market. What were they saying about the outlook for supply and demand and the role of China in both?
It's pretty much become a watch China show. China, the demand for physical gold for retail, for example, so people on the street, has increased 70% year on year, which is a pretty large amount given the number of people there. There's a group, now I've forgotten the name of it. There's a bank essentially who've set up what they call a gold acquisition program. So the ability for retail clients, so people on the street, to buy dollar averaged gold, so maybe $10 a week or $5 a week, to accumulate it and gain the value that way, has gone from 0 to essentially 70% of the gold supply out of China. And that's backed by the government, it's backed by the people, it's backed by the banks, so it's a pretty huge thing. Gold demand globally, we've seen India and China take over 50% of the world's jewellery supply, and that's nearly 70% of the world's gold supply, so that's a fairly huge number. China's rapidly catching up to India for demand, so India's demand on average works out to be about 800 tonnes a year out of 2,600 tonnes supplied in total. China took 500 tonnes last year. They're expected to either catch up this year or maybe overtake next year, but it's definitely a race. Supply in total, the World Gold Council have come back and said that total supply is up by 2%, but demand is down by 2%. We're still at a second highest level of demand in history, but we're sort of floating around that point. And again, it might be down to key drivers and seeing what happens.
When was the highest demand?
Last year.
Oh, right.
So we're not far off.
Right. And of course the central banks are a key player in this as well.
Yep.
And a big milestone for them in the last year.
Yeah, well, we've had 12 years of the central bank gold agreement. We've spoken about this before, where essentially it's primarily the European nations, the IMF's a group of this. They have agreed that they will only sell 500 tonnes a year on the open market and pretty much have reached that limit every year for 12 years. This year, they're net buyers. Complete turnaround. So we've gone from having 500 tonnes on the open market to 0. So there's a supply chain completely out the door.
Now, the other thing that's been of interest in the last month is JP Morgan has announced that it will accept gold as collateral when it does deals.
Yep.
Explain for me why this is important.
Well, essentially it's a paradigm change. So historically, gold in physical form, and this is what JP Morgan will only accept, hasn't been seen as a cash collateral, if you wish. So, people will happily accept paper money, they'll happily accept bond stocks, but they won't. Gold is now moving back into the mainstream. Now, this is something we had 50 to 100 years ago, where you could settle any transaction with gold. It was accepted as currency. That moved, especially after 73, we lost that entire ability. It became just another commodity, nothing else, and it's slowly but surely moving back into its monetary phase, so more of a monetary asset than a commodity asset. And JP Morgan accepting physical gold for repos and it was stock settlements from memory is a sign that it's becoming more and more mainstream and more acceptable to see gold as a replacement for, in this case, the US dollar.
And are there others who are doing this?
Well, there's talk around the traps that at the moment there's about 4 or 5 different states in the US who, as independent states, are talking about doing the same thing. So the ability to use silver and gold as settlement for different payments. It's definitely not on a federal level, but small things, big things will come.
Secession,
Well,
monetary succession.
Yeah, you never know.
Excellent. Mike O'Kane there from NZ Mint. He's the head of Bullion, talking about gold in a monthly gold report, another one of our double shot interviews. I'm Bernard Hickey for interest.co.nz.